Real estate or the stock market? The debate that will never end. The stock market investors will always point out how great the stock market is, such as the unbelievable rate of return you could have within a single year, while real estate investors will point out to the cash flow that real estate provides. Each of these groups are right. Both real estate and the stock market have their pros and cons, and the truth is somewhere in the middle, as always. If you were a stock market investor in 2020, it doesn't matter what stocks you invested in, you most probably made an incredible rate of return. If you had invested in tech companies, you probably doubled or tripled your money within a single year. And if you were a real estate investor, you probably didn't do much. Property prices increased by around 12%. That's nothing compared to how much the stock market rose. But in the context of the real estate, 12% is a lot, because the real estate market usually grows by 2 or 3% at best. So let's try to find out where should you invest your money in this year. Is the stock market better than real estate, or is the real estate still the greatest investment you can ever make? If you have $50,000 or $100,000 that you saved up, where should you invest it in? We will answer all of these questions and many more. But before we do that, make sure to give this video a thumbs up for the YouTube algorithm, and let's get right into it. When you buy a stock, it's just a digital document on the screen of your smartphone. You almost have no control over it, since your single stock isn't going to give you much influence when the company has another 5 or 10 billion stocks, while real estate gives you complete control over your investment. Even if you have taken a mortgage to purchase it, you can touch it, feel it, and control it. What sets apart real estate from other types of investments is leverage. With $50,000, you can control $50,000 worth of stocks. But when it comes to real estate, with $50,000, you can control $500,000 worth of real estate. I'm a big fan of the stock market. I spend hours every single day looking at charts and numbers or reading reports to find a good investment. But you have very little leverage when it comes to the stock market. Of course, there is something called margin investing, where you can borrow from your brokerage firm to double or triple your income from the trade, but it's not as much as real estate. On top of that, margin accounts are usually used for trading and not investing, since the interest you have to pay on the borrowed money is pretty high. While in real estate, you can get a decent mortgage rate for 30 years, especially now. We also have to consider the cash flow. Have you ever heard the term the king of dividends? These are the companies that are within the S&P 500 that have been increasing their dividends for the past 50 years or more. Think about it, 50 years is a long time. Booms and busts, inflation and deflation, high interest rates and low interest rates. These companies have survived and prospered through it all and kept raising their dividend rates year after year. One such company is Johnson & Johnson. Guess how much dividends does it pay? A little over 2.5%. And besides, the stock price did not even increase by 50% in the last 5 years. While when it comes to real estate, you can get 7, 8 or 10%. It all depends on the neighborhood and the property. So, if cash flow is more important to you, then real estate is the option to go with. But the problem with real estate is, it's nearly impossible to have such a high growth like you could have in the stock market, unless it's a bubble. Sometimes a company enters the game and revolutionizes the entire industry, and a $10,000 or $20,000 investment in that company could worth millions in less than a decade. Netflix is a great example, but it's just one out of many. Netflix stock price since 2012 rose by over 5,730%, which means every $1,000 that was invested in Netflix back then now worth over $57,300. In other words, if you invested just $18,000 in Netflix in 2012 without doing anything else, you would have become a millionaire today. The stock market is filled with such examples. When it comes to growth, the stock market undoubtedly wins. But if you're not emotionally stable, then the stock market isn't for you. The market jumps up and down every single minute. Sometimes it's all over the roof, rising like there is no tomorrow. And if you can't control yourself, you will start buying more when you shouldn't, since that plunge will be followed by a correction. And vice versa. When the stock is falling for a few days in a row, you have to understand that it's temporary and be patient. But what I don't like the most about the stock market is when you invest in a certain company, especially if it's a safe investment in a huge company like Apple, you do not feel like you own something. I mean, of course, theoretically, you are one of the owners of the company, but how much your $10, $20, or $100,000 investment in that company really worth? How much real wealth does it provide you when the company worth over $2 trillion, while when it comes to real estate, you own the entire thing? What we also have to consider are taxes. If you make $1 million and the government takes half of that, such as in the case of income tax, then you're not making $1 million. And that's where real estate also wins over the stock market. When your stocks rise in value, remember that you're only getting wealthier on paper. If you want that wealth to turn into real money that you can spend on yourself or buy another asset, then you have to sell your stocks and pay a capital gain tax, which is 20% for long-term investments and can go as high as 37% for short-term trades. With real estate, there are multiple ways to avoid taxes and use that cash to grow your wealth. For instance, instead of paying for the entire property upfront, you can deduct a portion of your mortgage attributables to interest payments on your tax returns. You can recover the cost of income-producing rental property through depreciation. Depreciation expense often results in a net loss on investment property, even if the property actually produces positive cash flow. This loss, as well as expenses such as utilities and insurance, deducted from ordinary income. Even if you end up selling the house, you can avoid paying capital gain tax if you purchase another property that's bigger. Tax incentives in real estate are unbelievable. It seems like real estate investors wrote the tax code. Alright, now we know all the ups and downs of both real estate and the stock market, and in many ways, real estate looks like a good deal. But the question is, what's the best investment now, this year? Well, the answer is a bit complicated, but let me simplify it. Real estate is a great investment, especially when mortgage rates are low. Even a single percentage is going to play a huge difference in the long run. So, with mortgage rates now around 3%, it's definitely one of the best times to take advantage. And for the past year or so, everyone who saved up for the down payment did take a mortgage. The Fed was so afraid that the pandemic will stop people from buying houses that it lowered mortgage rates from almost 5% in 2018 to 2.6% by the end of 2020. But that change in the mortgage rates led many people to take mortgages to the point where home prices rose significantly, as we have discussed in one of the previous videos. Home prices usually rise by 2 or 3% just to match with inflation. However, in 2020, in the middle of a pandemic, when most people lost their jobs, home prices rose by 12%. That's why many economists predict a certain correction. But that's just a prediction, because we're not out of this pandemic yet, and the Fed might keep mortgage rates low for another few years. Everyone who couldn't take a mortgage in 2020 will do that this year and in the next few years. So there's a very good chance that home prices will keep rising for another few years as long as interest rates are low. The same goes for the stock market. During the 2020 crash, the Fed stepped in and flooded the market with cheap money. It started buying junk bonds and even lent money to the largest corporations such as Apple or Microsoft. Most of these companies should have suffered last year, but the Fed chose to inflate the market to prevent a deflation. Of course, that's great. But what happens when the Fed increases interest rates or stops buying corporate bonds? Most of these companies will start suffering. So the market could witness a bigger correction compared to what we have seen in the last few weeks. But according to the Fed, it plans to keep the interest rates at the bare minimum for a few years until the economy is back on its knees. That's what the Fed plans. But that doesn't mean it's gonna happen. Only time will tell. If you have enjoyed this video, you will most definitely enjoy this custom playlist that I have created specifically for you that has our most popular videos on business, investing, and the stock market that could potentially change your life. And now, give this video the thumbs up that it deserves and make sure to subscribe if you haven't done that yet. Thanks for watching, and until next time.